Oxford Lane Capital. It is a long-term investor's nightmare. The actual value, the capital value of your investment in the stock has been decimated. It has been reduced by about 75% since it was listed. Now, yes, it does pay out a very high dividend yield. I don't think that dividend yield is anywhere near enough to compensate for the catastrophic decline in the value of this investment. Now, that's when you buy the common stock. I don't like the common stock for long-term investment. But like many of these CLOs, collateralized loan obligation companies, and we'll have a link to another video that talks a bit more about CLOs. If you want to know more about CLOs, do click on that link, learn a little bit more before you come back to this video. But like all the other CLOs, basically, these companies, like Oxford Lane Capital, they do have some fabulous fixed income vehicles. So in this particular case, we're talking fixed income. We're not at risk of losing our principal with these baby bonds, for example. We're going to maintain our principal and we're going to get a fat outsized yield. Now, if that sounds attractive to you, keep on watching as we get into it, and I'll tell you why I believe these are quite safe investments and why I've recently started a really nice position in Oxford Lane Capital. Let's get into it.
Okay, first of all, what are baby bonds? Now, for most brokers, a bond will trade at a face or par value of $1,000. Now, for many retail investors, this means it's going to be outside of their price range. It's going to be too big to handle. They're not going to be able to, say, diversify with a slightly smaller account. Now, baby bond simply means that the face value is much lower. It's a baby. It's a small size bond. So for many of the baby bonds, we're talking about a $25 per share face value. So that is a baby bond. Now, another really great advantage is it's probably going to trade on an exchange that you already have access to, as opposed to having to request bond trading permissions from your broker. Simply by having a share trading or a share investing account, a stock investing account, you should be able to access these baby bonds really easily and really quickly through your regular broker.
And major reason that I consider these baby bonds really safe is the amount of leverage that the company is taking on in this particular case. So if we look here, we're getting a look at the balance sheet from the most recent semi-annual filing. Now, what I want us to look at here is there are these two notes that are payable. Now, these are the baby bonds that are listed. Now, you'll note that these are about $97 million each. So we're talking about $194 million. Now, if we look down then, we're saying that this is very well because the company itself has $1,336 million in assets. So what this means is the value of these bonds is being covered almost over. And that gives me a lot of confidence that if something goes wrong, I'm going to be able to get this money back. So it's essentially about $800 million of common stockholder equity would have to be absolutely annihilated. Plus another $300 million of preferred stock has to be wiped out. But I would have the risk of being as one of the bondholders. Of looking at this is simply a matter of leverage. Have a current market value of about $175 million compared to $1,336 million. So the leverage here in terms of the bonds is only about 13%. Now, my friends, that is low leverage and that gives me some confidence. Now, it's also important to note that these baby bonds are at the top of the capital stack for this company. So that's absolutely wonderful. The company has no other secured debt. It has no other borrowings. And it's not a credit. So this basically means I'm at the very top. When something goes on, I will get paid out first. And I know that there's a huge number of assets there to pay me out if something goes wrong. So that gives me...
Reason number two, there are very strict limits on the amount of debt that this type of company can take on. So a closed-end fund, a CEF, such as the underlying Oxford Lane Capital, they can only take on up to 50% debt. Now, on top of that, there are very strict limits to what they can do. In fact, these are actually stricter than the BDCs, the business development companies that some of us are more familiar with. Now, it's also important to note that for this closed-end fund, the actual leverage limit from bonds is actually limited to 1/3. so 33%, and that is a very low limit. Now, when you wrap all of this together, this is often why you see so many high credit ratings for the fixed income from closed-end funds. It's because they've got this very strong limit imposed, which means they're not going to be over-leveraged, which means that the fixed income asset is more likely to be secure. It's also fascinating to note that while they could lift their debt higher, Oxford Lane Capital has chosen to keep that debt at a very manageable level. And because it's at a much more manageable level, this adds safety and it adds to my level of confidence that if there's a problem, I will be safe as one of the bondholders. Number 3, something was going to go wrong. If it looked as though this company was going to exceed that very strict limit, which they're not close to by any stretch of the imagination, if that was going to be happen, they can simply issue more shares. Now, traditionally, this company's managed to issue the shares at a premium, which has been very good for the company. What does this mean? It means that if they're at this limit, they issue more shares, that debt to equity limit then normalizes to a safer level, and that's going to be good for the company. Now, as I said before, this is a long-term investor's nightmare to invest in the common stock because of that constant lowering of the value of your investment in the common stock. And that's partly down to the constant, massive pumping of shares onto the market. They have been issuing more shares the whole way through as the value of those shares has dropped. Again, this is actually good for me if I'm holding the bonds. Why? When the bonds were issued, there were far fewer shares and a far lower market cap for the company. So again, the value that would have to be eaten up and destroyed on those common shares and the common equity was much lower than it is now. Now the company is much bigger in terms of market cap, even though the share price is much lower. And that means that there's a whole lot more that has to go wrong for the company because of that huge market cap that can be eaten up before it would affect me as one of the bondholders. Now that is exciting.
As I noted before, I personally think these baby bonds are seriously undervalued. And so one of the big questions is, well, there's several baby bonds out there for these CLOCEF companies. So which one do we invest in? What I've chosen to do is I've chosen to pick up OXLCZ. Now the reason for this, out of ECC and OXL. This is the baby bond with the nearest maturity date. So its maturity date is in 2027. Now it's 5%. Now that's 5% at face value because it's trading below that $25 face value at the moment. It means that the actual yield on what I paid for is higher. But more importantly is this concept of yield to maturity. The yield to maturity suggests that it's going to go up from this point at $22.50 roughly that I purchased it at. It's going to then increase up to $25 before that maturity date. And so that gain, that capital gain, is part of the calculation here for the value it's giving me as an investor.
Now, the yield to maturity for bonds can be relatively simple to calculate, but for many people, a yield to maturity calculator like this on the screen now is possibly an easy, simple way of doing the calculation. Now, as we look through this, we can plug in the numbers here. So I was picking this up today at $22.65. The par value, or the face value, as I said, was 25. It is currently 3.126 years to maturity, and it has that face value coupon rate of 5%. That's paid out quarterly, and what that comes to essentially here is a current yield. So this is the actual money being paid on the value of the investment that I've made. It's got an actual yield here of about 5.5%, which is not too bad. But as I take into account that increase in price from $22.65 to $25 over that 3 years, that actually pushes out the yield to maturity to about 8.4%, which I believe is a very, very respectable yield to maturity for the very, very high level of safety that I'm seeing in these baby bonds today. These investment decisions are going to be personal to every family and every individual. Now, for me, at the moment, taking on some of the investments into bonds is making a lot of sense, and I've been making quite a few bond investments over the last month or two, shifting some of the investments into bonds, giving me fixed income and more security security, because if there's turmoil in the stock market, the value of these bonds is not going to change too much, in my opinion. So it gives me more safety and I'm higher up that capital stack. Does it make sense for you? Let me know in the comments down below. Has this given you another good look at baby bonds? Is this something that you are interested in? And how well would this fit within your own personal portfolio, meeting your own personal needs and objectives at this time? I'm curious to hear your thoughts on baby bonds. And for the record, this is the first investment into baby bonds that I have made. I'm also interested to hear your thoughts and find out more about whether or not it's going to fit for you and your family. Now,